Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. The S&P 500 seems to be breaking out above its downwards price channel. After briefly reversing off that level of resistance, it seems to be taking out this bear market structure and the horizontal resistance level of 4,200. But as I'm going to show you in this video, this breakout is anything but convincing. And I'm not just saying that because we have a bearish macro view on the market 6 to 12 months from now. There are lots of short-term signals that do suggest that this is an unconvincing breakout. And I would say all the data that I'm going to show you in this video is correct. It's factual, but how we interpret data will always have a degree of subjectivity. So make sure to take everything that I say in this video with a grain of salt. Also, don't forget to click on the like button if you enjoyed this video. And of course, subscribe to the channel if you haven't already. Now, without further ado, let's get right into it. So let's start off by taking a look at this technical structure that we can give a little bit more room if we want to, right? If we extend this channel and we grab the very extreme ends of these candlestick tails here from June and from October of 2022, and we also take the extreme of the January 2022 high here, we get this price channel here that is theoretically still intact. So I always personally like to give these types of levels a little bit more room, especially when they coincide with such strong levels of resistance like the 4,200 level here. It's hard to say that the recent move really took out this zone of resistance. We'd need to see more upside, more follow through on this move, and that's when you really can say that we've cleared this level. As a quick side note, I want to remind you guys there's only a few hours left before the end of the offer on our service. We're giving access to all the features on our website completely for free for a whole month. That includes the model portfolio, it includes all the premium videos, the premium articles, the investment ideas, the tactical watch list where we take a look at the short-term price action and we give you guys our macro targets. If you click on the description below and subscribe now, you'll be able to test out the service from A to Z free of charge. So for the sake of this video, we're going to say that the S&P 500 did break out above this level. In that case, why is that happening, and should we believe it? Is there actually a lot of underlying strength behind this move that tells us it has more fuel to run much higher before reversing? Could it lead to a bull run that will last multiple months, if not even multiple years, as some people are calling right now? Well, if we take a look at what's been leading this market higher over the past couple of months, it's been the NASDAQ 100. The technology sector has been extremely strong here. A lot of optimism around artificial intelligence that's dragging the whole stock market higher. And of course, this is technology that is going to have a massive impact on society as a whole in the future. But these stocks right now are discounting a lot of good news very quickly. If you take a look at the RSP, the S&P 500 equal weighted ETF, so the mega cap stocks of the S&P 500 that have been very strong recently don't have as much of an impact on this ETF, and you can see more recently it's been extremely weak here, not only making a significantly lower high here in May relative to the February high of 2023, but also since April here you can see we've been trending down on the RSP. So the move that we're seeing here in the stock market is not a strong, broad move where a huge number of stocks are participating in this rally. This is really just the tech sector that's dragging the market higher. The rest of the market doesn't seem to think that we should be pricing in a recovery. The rest of the stock market is still a lot more pessimistic about future growth, future economic activity than tech stocks that are pumping based on this AI euphoria that we're seeing right now. And by the way, we have the same thing on IWM, the Russell 2000. These are small caps. You want these stocks to outperform during cyclical recoveries. This was IWM during the reopening trade in 2020. right before we had a massive economic boom in 2021. They were leading the recovery. The same thing was happening in 2015. IWM was leading the recovery as you were about to have a period of strong economic growth between 2016 and 2018. The same thing goes for the recovery of the March 2009 low. IWM, the Russell 2000, was the leader among stock market indices throughout that period as it was pricing in a real, true cyclical recovery in the economy. Look at where this index is right now. It's telling a completely different story. It's right there near the lows and has barely recovered since this October low here. So investors that have been betting on the fact that we are currently experiencing a soft landing and that we're actually seeing the recovery, the economic boom following the recession, and that all the bad news is behind us. If you wanted to bet on that scenario, you would have bet on small caps, and that trade just has not been playing out right now. What you are seeing is stocks like Nvidia that since October have beaten the markets by 130%, getting overextended to levels that have been seen only a handful of times when it comes to Nvidia's relative performance against the S&P 500. You can see when it does get this overextended, the risk of short-term downside on these stocks is quite big. We saw this many times on Nvidia before, where you have this type of severe optimism that is quickly reversed. Now, of course, sometimes it is justified. Sometimes the fundamentals are actually growing. We're actually seeing demand hold up to very high market expectations. But you look at really how high these expectations are right now. Nvidia right now is trading at a PE ratio that is in the 96th percentile relative to the last 10 years. And this bar here, this red bar, shows us how much more expensive it is relative to 2019. So both Nvidia and also Apple are a lot more expensive than they were back in 2019, when, by the way, the Fed was already cutting rates, easing monetary policy significantly here in 2019. Rates were already below 2%. Here, we're still not really at the end of the tightening cycle. The Fed may even hike rates again in June. And you look at Apple's PE, it's trading in the 89th percentile of the last 10 years. So valuations have rarely been this elevated for Apple, for Microsoft, it's in the 79th percentile, so pretty elevated, and Nvidia. And these are the stocks that have been leading the market higher. Just look at this chart of the NASDAQ 100 against the 10-year yield that's inverted. This is a chart that we were talking about a lot back in 2022 because of how important this is to understand the macro environment that we're currently in. Rising yields in this environment, so the orange line here going down, rising yields were a massive headwind against technology stocks. They had almost a perfect correlation. Look at what's been happening more recently. Well, you've had the tech sector completely disregard what's been happening in the bond market as rising yields have been returning once again. The bond market is clearly being a lot more pessimistic about how easy monetary policy is going to be in the near future than the NASDAQ 100 that's pricing in these extraordinary PE ratios, being extremely optimistic. If you compare to an asset like Bitcoin, it shows that crypto is actually not in a bubble and actually trading pretty fairly relative to where yields are right now, pricing in the more recent rise in rates and rising Fed rate hike expectations. Now, of course, as they say, the market can remain irrational for longer than you can remain solvent. Just because we see this as a bubble doesn't mean that we're going 100% short on tech right now. If you're subscribed to our service, you'll know that we do have a short position on tech, and we'll probably be increasing that position in the near future. Ultimately, tech is in a bubble right now, and that's what's dragging the market as a whole higher right now. You actually look at underlying cyclical stocks, they're really not showing signs of a recovery right now. The stock market breakout that we're seeing is very narrow, and it is being fueled by stocks that are extremely vulnerable to seeing a reversal quite rapidly as the market realizes that it is pricing in too much optimism relative to reality. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and of course subscribe to the channel if you haven't already. Now in the meantime, I wish you good luck on your trading and see you next time.